Morningstar have released an article of the 10 cheap dividend growth stocks to buy now as we head into 2024. And in today's episode, we are going to focus on 3 of these companies that are showing a discount to their price of up to 50%. Now we're going to take a look. They have released 10 stocks. We're going to take a specific look at 3 of these which we haven't reviewed on the channel in more recent times. We're going to take a look at each one of these as well as run them through our valuation model, getting to our intrinsic value for each company, looking at their acceptable buy price given our investor margin of safety. Now the first one we are looking at today is Albemarle, which currently per Morningstar they see this trading at around a 57% discount with a fair value estimate of $300. Now for those that are new to this company, they are operating in the specialty chemical industry, and we can take a quick look at their performance. We're also going to jump into their dividend safety as well as some of their strong supporting financial metrics for each one of these 3 companies. Now, as we can see, they are down around 30% year to date, trading towards the mid to lower end of that 52-week range with a yield of around just over 1%. Now, essentially, investors who have been holding this company over the last 10 years would be up around 136% without those dividends reinvested, and we can see it did hit its all-time high at the back end of 2022 at around $325, which is more than double the current trading price. So let's take a deep dive in the financial metrics before we touch on the valuation. So as we can see, a dividend safety score of 99, it is very safe. Market cap just under 18 billion, so we're talking about a large cap company. Now for those that see a recession inbound in 2024, well, recessionary metrics show they increased the dividend during the last recession, below average growth of companies in the S&P 500, which was around negative 12 to 13%. And they also did significantly underperform the S&P with a negative 63% return versus the S&P's negative 55. Now, dividend growth, what are we talking about? Well, a subpar increase in February this year of 1.3%, below the 4% I always advocate on the channel to get as a minimum to keep up with inflation over the long term. Last 5 years, it has been keeping up at 4%. Last 20 years at 9%, which is more positive to see. Now, in terms of the number of years, well, they have been increasing those dividends for 28 years, so they are officially a dividend aristocrat. For those that are new, well, dividend aristocrats are companies that have increased those dividends for 25 years or more. Now, dividend yield theory shows that a company is undervalued when the current yield sits above the 5-year average, so we have a sign of undervaluation, but as always, we never look at any of these models in isolation and we'll draw our conclusions towards the end of the episode. Forward P, however, is slightly higher at 16.8 versus the 5-year average of 14. And when we do take a look at the sector PE, ALB is still below the sector PE for materials at 18.4. Now, in terms of the payouts, as always, we do focus on the free cash flow payout on the channel. Earnings data available if you want to take a look, but it is susceptible to manipulation by management through accounting, so we draw your attention to the free cash flow. Personally, below 60% is what I like to see, means that management have the ability to offer those double-digit increases. Now, we can see it has been pretty inconsistent. 2022, however, was 29%. 2023 is expected to be 40%. So it is below that 60%. And I would like to see the dividend increase next year being a lot higher. Free cash flow per share, well, 331 in 2013, 552 in 2022. Yes, it has increased over the last 10 years, but 2 things to note. One, the inconsistency, as we do see a number of years where it was essentially negative growth on the free cash flow, but also 2023 it is expected to drop slightly, and some could argue the cyclicality of the industry. Sales growth, well, actually a more positive outlook. Double-digit increases of quite significantly in terms of the number of years over the last 10-year period. 2022, an incredible increase, triple digits. 2023 expected 77%. So yes, we do see some years of negative growth, but they are often followed by periods of strong growth. And when we look at that numerically, we can see, in fact, nearly 3 times growth over the last 10 years, from 2.4 billion to 7.3. Now, shares outstanding, we love it as investors when companies return excess cash to our pockets by doing share buybacks. But do note this company has diluted your position over the last 10 years by increasing that equity. Now, when we take a look at ROIC, 10% or more is what I want to focus on. It gives me faith that management are able to effectively allocate their capital. Pretty inconsistent. We see some years of strong double digits, some years of mid-single digits. Two things to note. Well, 2022 was 21%, 2023 at 16%. So it does show us that management over the last few years have been able to effectively allocate that capital. Operating margin on the left, well, consistently above that minimum 12%. It does tend to go up and come down. 2022, very strong at 35. 2023, again, very strong at 23. Free cash flow margin, a lot more fluctuating as we can see, although 2029 was pretty strong, with 2023 coming pretty much in line with the minimum we like to expect. Net debt to EBITDA, earnings before interest, tax, depreciation, amortization. Remember, it shows us two things. Firstly, the dividend safety, and secondly, the balance sheet strength. Below 3 is what we like to see. These numbers show us the number of years, or minimum number of years, it would take the company to pay off all of their debt net of cash on hand. 2022 at 0.57, 2023 expected very similar. Does show us why it does have a very safe dividend score, and we can see a very strong balance sheet. Now, let's take a look at the valuation model. As always, on this channel, what we typically do is in-depth reviews of each model: Graham's valuation, multiples valuation, the dividend discount, and the discounted cash flow. For today's episode, we'll jump straight into the final intrinsic value, which is just the average of the models that we use. Different companies, we use different models, some all of them, some only a few, and we do explain in each video why we exclude any. So the intrinsic value for ALB is coming to $207. Current price sitting around $150. Now, margin of safety, we typically start off with 10% if we believe it has a wide moat, strong financial metrics, good forward-looking data. And what we can see here, it is a buy up to $187 if you believe a 10% margin of safety is appropriate. At 15%, it's still a buy at $176. At 20% at $165. 25% around $155. And 30% slightly lower than the current trading price. So for ALB, we do believe it has around a 25 to 30% margin of safety. Wall Street, well, they believe there to be some significant upside, in fact, to the current trading price by around $50 per share. So what we are saying in conclusion, for ALB, you're looking between 25 to 30% margin of safety based on our estimates and judgments, with Wall Street expecting around a 30% upside over the next 12 months. Do bear in mind, though, this is the average Wall Street price target at $200. However, when we do take a look at Morningstar, they do believe this to go even higher to around $300. So let's take a look. So we're going back to the list now, and the second company that we are taking a look for today's episode is Discover Financial Services. As we can see, Morningstar see this as 43% undervalued, and right now it is currently giving a forward yield of 3.11%, and it is in the credit card services industry. So let's take a look at the company. Now, year to date, they are up 14%, still lagging behind the S&P up around 25%, in the mid to upper end of the 52-week range, with a dividend yield of 2.5%. Now, if you've been holding this for the last 10 years, you would be up a fairly respectable 104%, excluding those dividends reinvested, and we can see all-time highs summer of 21 around $136. So let's take a look. We see the dividend safety score at borderline safe. Market cap $28 billion, a large cap company. Now, recessionary metrics, a few points to note. They cut the dividend during the last recession, below average growth, and significantly trailed the S&P with a negative 77% return. In more positive news, very strong dividend increases, double digits this year at 17%, double digits over the last 5 years, double digits 19% on average over the last 10-year period. And as we can see, they have been increasing those dividends for the last 12 years. Now, dividend yield theory, as we can see, we have our sign of undervaluation at 2.52 versus 2.24. But do note the forward PE does sit slightly higher at 9.3 than the average at 8.6. But it is still significantly lower than the sector PE in the financial industries of 11.1. Now let's take a look at that free cash flow payout, and as we can see, very, very strong, well below, in fact, even 20% every single year. So we can see why the dividend has increased double digits every year for the last 12 years, as well as the fact we expect that again for 2024, only sitting at 9% for last year as well as expected this year. Moving on to the free cash flow per share, well, very nice to see consistent increases for the large part over the last 10 years, and in fact it has increased nearly 4 times over the period from $6.77 to $24.90, and is expected to go even higher in 2023 to $29. Moving on to the sales growth, typically steady moderate growth 3 to 7%, pretty inconsistent. We do see that COVID lockdown year down 28%, although it did rebound very strongly, but note both 2022 and 2023 is expected to be negative growth. Numerically, how that looks, well, 7 billion in 2013, 11 in 2022. One thing that they do very nicely, very rewarding for the shareholders, are those share buybacks. 487 million in 2013, 278 in 2022. So very, very positive. They have bought back over 200 million shares over the period, nearly half the amount of shares they had outstanding during that period. Return on equity, well, we can see above that 10% that we look for, and in fact, in 20% nearly every single year or more. 2021, 2022, very strong years. 2023, although lower than the previous year, still very high at 25%. Now, when we look at that free cash flow margin, very positive to see, above 5% every single year. In fact, 63% in 2022, 73% in 2023. Finally, when we look at the net debt to EBITDA, we see it performing very strongly with nearly zero effectively for the period. So now let's jump into the valuation for DFS, Discover Financial Services. And as always, if you're enjoying the content, value is being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. And also for those that do want to, do click on that pinned comment below where you can get a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies, not only in your own portfolio but on your watch list. So intrinsic value comes to $143 with a current trading price of $111. Now with a margin of safety of 10%, it's a buy up to $129. At 15% up to $121. At 20% up to $114. And at 25% it is still a few dollars shy. So currently you are getting, based on our estimates, a good 20% margin of safety. Well, what do Wall Street say? Well, they do believe there to be some nice upside at around 20% to the current trading price. So in conclusion, for Discover Financials, we are looking around a 20% margin of safety with around 20% upside per Wall Street targets. We then move on to the third company, which is heavily discounted per Morningstar, which is Estee Lauder, which they believe should be worth around $200 per share at a 38% discount below the fair value estimate. And they do see their dividends growing steadily over the next decade, calling this a wide moat company with a forward yield of around over 2%. And for those that don't know, the industry is household and personal products. So let's take a look. This is one that we did cover quite some time ago, where it did have a huge drop down to its 52-week low. As we can see, year to date down 43%. 52-week low is there or thereabouts towards the mid to lower end with a yield of just below 2%. Now over the last 10 years, it is up around 94% without those dividends reinvested. And we see towards the end of 2021, beginning of 2022, its all-time high of $370, more than double the current trading price. So dividend safety does sit at 60, borderline safe, 52 billion market cap, a large cap company. Recessionary metrics, while they maintained the dividend, had about average growth during the period and a near recession return in comparison to the S&P's negative 55. Now they haven't increased those dividends just yet since November 2022. Over the last 5 years, it has been double-digit increases, and over the last 20 years, again, double digits, 18%. Now moving on, taking a look at their dividend yield theory, we can see some signs of significant undervaluation with that current yield way above that 5-year average of 0.94, although do note the forward PE does sit higher than the 5-year average of 39.5. Now taking a look at the free cash flow payout, typically it has been below 60% over the majority of the period, but do note we do see negative here due to the net loss that they had in 2023. And 2024, however, it is expected to go up to around 93%. One thing to bear in mind, whenever this gets above 100%, it means that management are paying out more in dividends than they're generating in free cash flow. And we can see here, over the last 10 years, it's gone from 265 to 556 in 2022, before that 2023 period where it did drop to negative, minus 4.35. But a lot of you could argue that that is essentially why the price has taken a massive hit, and effectively it is up to question whether or not this company is significantly undervalued based on that forward guidance as well. Sales growth, while 2023 wasn't a great year, double-digit negative growth, and we did see a few times in the period, 2020 and 2015, but at the same time we did see some double-digit growth as well. So when you do look at that in terms of the numbers, 11 billion in 2014, 16 billion in 2023. Now, shares outstanding, 393 million to 361. They do share buybacks over the period, maybe not as consistently as one would like, but it is something they do to reward those shareholders. ROIC, now this is very good. I do like to see double digit, very strong as well, but one thing to note here, from 2014 it has started to decrease. 10% in 2023, although that is effectively still above that 10%, or at least at that 10% or more I look for. Just one thing to keep an eye on, as what you don't want this happen is for this to continue to decrease and then start going below into the single digits. Operating margin, very positive up to 2022. 2023, it did decrease to around 11%. Again, something just to keep an eye on to ensure their margins do go back up to the levels we saw. Likewise, a very similar story on the free cash flow margin, very positive up to 2022 before 2023's drop into the negatives. Now, net debt to EBITDA, we do effectively see in 2023 at 1.97. Now, it is expected to go up in 2024 to 2.32. So again, just something to consider. These are all points that if you are thinking about an investment, just to take your own time to do your own due diligence to consider whether or not you do believe in the direction of this company going in the future. And you can take a look at management's forward guidance to get some idea about this, as well as their latest annual accounts. Now, stock valuation, so the intrinsic value is $180 for Estee Lauder. And as always, don't forget to smash that like button if you've enjoyed today's content and hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, a 10% margin of safety, we see here acceptable buy price of $162. If we move this to 15%, around $153, and at 20%, pretty much a few cents shy from the current price. So we do believe it have around a 20% margin of safety at the current value. In terms of Wall Street and what they see, well, as we can see here, they do believe there to be just under 20% upside to the current trading price. So for Estee Lauder, we see around a 20% margin of safety based on the estimates and judgments, with Wall Street expecting just under 20% upside over the next 12 months. Although do note, based on the Morningstar, they believe this to go up even higher to around $200. So Morningstar, in fact, see a higher fair value than the Wall Street targets. As always, if you've enjoyed the content, let me know in the comments below whether you like a lot of this content where we do run through articles, whether it's Morningstar or not, and analyze stocks that they do look forward to 2024 and beyond. And don't forget, drop your comments below whether these companies are ones that you do believe, similar to Morningstar, are severely undervalued, or whether or not you aren't touching them for whatever reason. As always, if you do want to grab a copy of the valuation model, click on that pinned comment below where you can get the intrinsic value and acceptable buy price of companies in your own portfolio or on your watch list. Don't forget to smash that like button, hit that subscribe and bell button. Happy holidays to you and your family, and as always, I'll catch you on the next episode. Take care.